Hi, everyone. We apologize for the technical difficulties. Welcome to you, UMPIP and Your Future, which is a quarterly webinar series with the focus being on the United Methodist Personal Investment Plan. I'd like to introduce you to the team that will be working on this quarterly webinar series throughout the year. My name is Bob Christophel. I serve as the Manager of Benefits Education here at Wespath. Co-presenting with me this afternoon will be Sheryl Hatcher, our Senior Benefit Plan Specialist, and working diligently behind the scenes will be our benefits educators, both Todd Creviston and Frank O'Brien. I want to remind you that this webinar is being recorded. We do want you to ask questions as we go through the material. Please use the question box in the GoToWebinar toolbox to ask any questions, and Todd and Frank will be handling those questions. We do have a couple of attachments on that toolbox as well, including UMPIP at a glance, LifeStage solutions, EY financial planning, and an incoming rollover form, as well as a new piece, retirement plan acronyms. As you probably know, we use a lot of acronyms. We'll try to stay away from that today on the webinar. That is just really for your future reference. We always begin with just a little information on Wespath. We are a general agency of the United Methodist Church. We manage approximately $24 billion in assets. We take care of, yes, we do a lot of participants, over 100,000. And that number would include clergy, lay participants, as well as an important group of surviving spouses of those participants. Our basic mission here at Wespath is caring for those who serve by providing these types of retirement plans, both defined benefit and defined contribution plans, but it's also health, wellness, death, and disability programs that honor really the mission and principles of the United Methodist Church. We're coming to you from Glenview, Illinois. We were in our Spellmeyer studio, ran into some technical difficulties, but what we say is the webinar must go on, and that's what we're going to do this afternoon. I want to thank all of you that have attended previous webinars in this quarterly series, which has been going on for almost 3 years now. But what we've done after each webinar is send out a survey, and we look carefully at those survey results because, again, this is your webinar, your United Methodist Personal Investment Plan. So we get a lot of great feedback about content, and we're going to build upon those surveys the additional segments in this series. We get some interesting suggestions like, hey, more about surviving spouses. What about other retirement planning vehicles like HSAs and HRAs? A lot of interest in rollovers. And if you had submitted that, you know, you're in the right place. Sheryl Hatcher, who will be co-presenting this afternoon, is our rollover specialist at Wespath. So we'll talk a little bit about rollovers today. We got a lot of great suggestions. Some people said it was too intense, too high level. Others said it was too basic. Some people said we talked too fast. Others said it went too slow moving. So we're going to try to really accommodate everybody, but I think it's most important to focus on the content requests that we got. And that's what we'll be looking at. But I don't want you to wait for the next quarterly installment of this series. Plenty of help in between quarters, including we'll talk this afternoon about the Benefit Education Consultation Program, where you can meet face-to-face with me or Frank or Todd or Sheryl in a virtual one-on-one consultation. Again, we are here to serve. Let's look at what we'll be covering in this second quarter segment. We're going to focus on some of the basics. How do participants make contributions? What are the different ways? How much can I put into the United Methodist Personal Investment Plan? As well as some basic retirement planning concepts. Sheryl is going to begin with an introduction to the investment part of your 403B plan, the United Methodist Personal Investment Plan. We'll talk about the investments one by one. We'll also explain what category they fit into. We'll talk about LifeStage investment management, which is an important service available to our participants to help set your accounts on autopilot. We'll also go into the services that are available. We have some really beneficial, meaningful services available to you, as well as some tools in your retirement planning process. Sheryl will talk about benefit projections and how they're a valuable tool, shooting a camera into the calendar to stop at a particular date and time to see what retirement income will look like. We'll give you the link for the benefit education consultations. And these webinars really are designed to promote and encourage action. And we did ask that question after the first quarter. What steps are you going to take? And we love to see those responses. Some folks said, hey, thanks for the reminder. I'll update my beneficiary designations. I'm going to call EY and talk to them about Roth contributions. I'm going to register for benefit access for the first time, as well as a lot of folks indicated that they were going to enroll, actually take that important first step and enroll in the United Methodist Personal Investment Plan. So we'll remind you of some of those action items as well. Now, before we get started, just a kind of a commercial, a little bit of promotion. I am just really excited, very excited, as is the benefit education team and the event planning team and the communications area at Wespath. We will be going back to one of our signature events, or really two of our signature events, the Clergy Benefit Academy, or CBA as we call it, for clergy 40 and over, as well as the signature event geared toward younger clergy under the age of 40 called Rev It Up. We haven't had these signature events on site since February of 2020, so a really long time. But we do have both CBA and Rev It Up scheduled in November in beautiful Broomfield, Colorado. We want you to be inspired to come to these events. Here are the dates, and if you want to just find out some more information or actually register, visit us at wespath.org/events. The registration links are open, and we would love to see you there in Broomfield, Colorado. It's going to be a great week, beginning Monday and ending on Friday. Each event is 2.5 days, so look forward to seeing you there. Now let's jump into what some of our participants call UMPIP, or the United Methodist Personal Investment Plan. And you know, it's a terrific plan. It's available for clergy. It's available for lay participants. It is basically, it's a retirement plan. Wespath, myself, your employer, even the government are encouraging you to set aside some money today to start to accumulate funds for your retirement. And I think there's really good reasons for that. Everybody knows by now that Social Security as a retirement plan is good, but it's simply not enough to replace your paycheck, which will eventually go away. So it's important, even if you start out small, even if you start out mid-career or early career, and I have some examples of that, there are different ways to make contributions to this plan. It does give our participants really, I think, a lot of flexibility, a lot of control, and many of our employer plan sponsors also will offer a matching or a non-matching contribution. So check with your employer on that. It is a terrific plan. If you have a financial advisor, or if you're working with EY, a tax person, they're going to encourage you to look at these plans very closely and to take advantage of these plans. You are eligible to make contributions if your employer sponsors UMPIP immediately upon hire. There might be an eligibility requirement, a period of time before you start to receive employer match or non-matching contributions if available. But you decide how. You decide how on several different things. How much to contribute from your paycheck, and you could do that as a percentage or a flat dollar amount. But you also decide how to contribute, and we'll look at that. You know, how it comes out of your paycheck will determine how it's treated later on. You also decide how your account is actually going to be invested. We do have some participants that are self-managing their own accounts. Yes, they are. They're choosing the investments. They're keeping track. They're rebalancing or changing those investments from time to time. And still many other participants are utilizing a service that Sheryl will talk quite a bit about, LifeStage investment management. So you have a lot of flexibility here, and you're allowed to make changes to your paycheck at any time. So really, depending upon what you're trying to do, some of our participants are trying to avoid taxes now, and they'll make before-tax contributions. Still others are trying to avoid taxes later. We'll talk about Roth contributions as an important way to avoid taxes later. These plans, these defined contribution plans are portable, okay? They're designed to follow you around. So if you are late career or mid-career clergy person or a late participant that has recently joined your employer and you have a previous employer's plan, this plan does accept direct rollovers. And a rollover just means moving money from one place, one qualified employer plan, or perhaps from an IRA into the Wespath United Methodist Personal Investment Plan. So let me show you the different ways that you can make contributions, the different, really, I like to call it sources of money, separate balances. You might have one, two, or several of these participant contribution sources. The most common one we see, yes it is, it's your before-tax contributions, okay? What you're doing there is reducing your taxable income. Roth contributions is a form of after-tax contribution, but it could be tax-free later on if it comes out as a qualified distribution. I mentioned the rollovers, the portability that's built in to these defined contribution plans. And then the last one that's usually considered is a straight after-tax contribution. So let me tell you a little bit more about each of these sources of money coming out. Again, the only way to get money into this plan is through your paycheck. So the before-tax contributions, what you're really doing is saying, hey, wait a minute, the first thing coming out of my paycheck, I'm going to be paying myself first, making this contribution to the United Methodist Personal Investment Plan. So your contributions and any earnings, money that you make on your investments, be it income on like the stable value fund or the bond funds, you experience growth, everything is growing tax deferred. So you're not receiving a 1099 tax form every January. So you're not paying any federal or state income taxes right now until you receive those distributions in retirement. So that's a common way to put money into this plan. Now, the second way is a Roth contribution. And I can't talk to you and say, yes, Roth is a good thing, you should do Roth, or you should not do Roth. I just don't know enough about everyone's financial situation. But I do know enough to say it's a good idea to consider Roth. Check with a financial planner, check with EY Financial Planning Services, which we'll talk about this afternoon, to see if Roth is right for you. Roth gives you the ability to avoid taxation later on, okay? So you pay taxes now and tax-free distributions of your contributions and any earnings or growth on those investments later on. Well, how does that work, Bob? It sounds good. Well, in order for it to be tax-free, it needs to be a qualified distribution. And that means that the first contribution, but not everyone, had to be in your account for at least 5 years prior to the withdrawal. You got to be at least age 59 and a half, or in the event that you pass away or become disabled, then it would also be a qualified distribution. So Roth contributions, again, you want to check. Maybe that's one of those action items to check to see if Roth contributions are right for you. Let's review this year's contribution limits. And these were raised from last year. And I always tell participants, they ask, how much should I be putting in? I don't know. Everybody is different. Every situation is different. I always encourage participants to put in what they reasonably can afford, but they should be aware of what amount, either a percentage or flat dollar amount, is coming out of their paycheck. Maybe you haven't looked at this in a while. Maybe there is some room to increase it. The limits are high. This is a voluntary plan. So for most people, it's anywhere from 0 all the way up to $20,500. That's a lot of money. Put in what you reasonably can afford. In addition, if you are or will be over the age of 50 in this year, even if it's at the end of the year, and you've maxed out on the regular contributions, you are eligible to contribute up to an additional $6,500 in what's called a catch-up contribution. So really, for some folks, you might see them maxing out, putting in a total of $27,000. Again, put in what you can afford. The total of employer and participant, all sources, not including rollovers, can exceed $61,000 for this year. So the limits are quite high. And then usually what's considered last is what I call your straight after-tax contribution. And what makes this different than the Roth contribution is that your earnings, any growth, any dividends that came in, income that's paid on some of these investments, that becomes taxable later on when you take a distribution, not the contributions themselves, because you've already paid taxes on those. Again, rollovers really just refers to the portability of these plans. If you have money from a previous employer's plan, check in with our rollover specialist, Sheryl, to see if it's an IRS qualified plan that can be rolled over, moved from one financial institution to Wespath, the United Methodist Personal Investment Plan. We also accept IRAs, traditional IRAs, those can be rolled over. So it requires some paperwork. Give us a call and we can help you with that process. Rollovers in are always kept as a separate source of money, a separate balance, if you will, and are available for withdrawal upon request. Let's look at some basic retirement planning concepts next. All right, I talked about the different ways that you can contribute to the United Methodist Personal Investment Plan. And I have a paycheck example here on this slide, and it's looking at someone that makes $50,000 a year. They're contributing 8% to the 403B, United Methodist Personal Investment Plan, and they file as a single taxpayer. So everybody has a gross pay on their paycheck. That's the amount before anything else comes out. Making contributions on a before-tax basis is not going to impact your Social Security benefit. Your Social Security, what's called FICA, will be the same. So this person that's decided to put in 8%, so they've reduced their taxable income. They're going to pay less in federal and state taxes. Okay, they're going to save, in this example, $20 per pay period. Now, if someone decides to do a Roth contribution, remember I said that was a form of after-tax contribution. They're going to pay the same in FICA, but their federal tax burden will not be the same. Okay, the contribution amount will be the same, but by making before-tax contributions, again, you reduced your taxable income and you have an immediate tax savings. That's what I said. You want to save money on taxes now. Roth, you're going to save money on those taxes later on. Now, this example, and the numbers aren't important because everyone's paycheck is different. But what it illustrates is an important concept with before-tax savings for a lay participant. Okay, you don't experience a dollar-for-dollar difference in your take-home pay. That's what a lot of people look at, their take-home pay. You'll see less of a difference because you're not paying taxes now on those contributions. So even though this person that's making these before-tax contributions of $166.67, they only see a difference in their take-home pay of $146.67. Again, because this is a before-tax contribution. A really important concept in 401k, 403b, defined contribution plans in general is this concept of dollar cost averaging. There's different ways to make investments. You can make an investment today all at once, send several $1,000s to an investment company, and you're buying in at one share price. But what happens in these plans, because you're investing money from every paycheck, you have a deduction, you're going to be buying in at all different share prices, sometimes higher and still sometimes lower. And we are obviously in a year where we've seen quite a bit of market volatility. This dollar cost averaging is an important concept. And what this chart shows you is someone that's investing $500 a month from their paycheck. Doesn't matter how it's coming out. It's coming out of their paycheck. And when the market goes down, okay, and that's represented by the gold line, you'll purchase more shares. That's represented by the blue line. When the market goes up, you'll buy less. When it goes down, you'll buy more shares or in units. And this is a proven and verified, efficient way to help build up your retirement balances over long periods of time. This concept of dollar cost averaging. The market can be very cyclical. This year, we know there's been a lot of volatility. We have seen this before. And Sheryl will talk more about Wespath's philosophy and practices for riding out these periods of a difficult market. So that is that concept of dollar cost averaging. Any questions regarding that? Just a reminder to submit any questions, not just on dollar cost averaging, but on any of these topics. Just be sure to put that into the question box on the toolbar. This chart I really like because it illustrates a couple of things. Time is very important in retirement savings, okay? It's not possible to build up balances in a month or a year, but over long, consistent periods of time, setting aside money. And this chart proves that even a little bit of money, a small amount, a small sacrifice now can grow to a very big amount over longer periods of time. It really is a good illustration. It's looking at a couple of things I'll point out. What if you start early? And everyone in the retirement planning business will tell you the importance of starting early. I tell that to my kids. Start early. Time is on your side. Time will help you, and you'll end up contributing less than if you start later. If you delay, it is going to hurt you. So the first thing we're going to track is someone age 25. They begin making contributions. They have compensation of $35,000, and they've decided to set aside just 1%. And this assumes that they're going to get increases of 3% a year in their compensation, and they'll make, I think, very attainable investment growth of 7% per year. That small contribution, and this doesn't factor in any employer component, can grow easily to over $100,000 by the time they reach retirement. Now, what if they said, well, I'm going to try to put in more. I will try to put in more than 1%. I'm going to try 4%. That amount is going to grow significantly higher than that 1% contribution. That's going to be a much bigger balance of over $409,000 with these assumptions at their retirement. What is interesting is the next scenario. Someone who says, no, I'm going to wait. And there might be very good reasons. They don't have enough money to contribute. They're going to wait. They're going to wait till age 45. And they're making a higher salary at that time. In this example, $65,000. And they're going to say, wow, I'm making up for lost time. I can't start out with 1%. I can't start out with 2%. I'm going to jump right in with 6%. And they have 20-year time horizon till age 65 retirement. Even though they're contributing a higher amount, they started late. They didn't have as much time to take advantage. So that balance in this example would grow to about $201,000. So certainly a lot to think about. I will be jumping into the question box as well. The next section, Sheryl is going to begin a discussion on the investment options available to you and then take you through the participant services. Hi, Sheryl.
Hello, Bob. You've done a fantastic job with everything that you were speaking about. That looks good. Okay. Well, thank you so much, Bob. I appreciate it. And we apologize for the technical difficulties in the beginning here, but I did want to let you know about the benefits of investing with Wespath. So let's talk about that. So Wespath actually does sustainable investing. So that's actually a twofold part here. So what we're looking at is looking at investments for the long haul, not something in the short term, but for the long haul. And also, we want to let you know that we are actually investing based on the social principles of the United Methodist Church. So we're only investing in ones that actually comply with the actual Methodist principles. So that is something that we definitely take to heart. Definitely, we want to make sure that we're doing what's good for you and for the plan. And as far as for you, you have your option to actually do the investment options. You can actually do the percentage amount, or you can do a flat dollar amount, as Bob had talked about that. So you have those as options. We actually do competitive returns relative to the benchmark. We do look at ourselves against our competitors, and we want to make sure that we're doing as well, if not better, than our competitors. And we're actually doing very well based on those. We don't have any, our expenses. We do keep our expenses lower, and there's no commissions on our funds. So what does that mean to you? Well, that means that more money stays in your fund and could potentially make more money for you. So that's what it's all about, right? So that's what's in it for you. And then another benefit and another advantage of investing with Wespath is this LifeStage investment management. Now, I know Bob alluded to it a little bit, but I'm going to be talking more about it in more detail as we continue on. Now, one thing I also want to talk about is that impact of investing with Wespath. So we do want to make sure that we are looking at investments that are doing good, okay, not just doing well, but also doing good for globally. So we do want to make sure that we're making a difference there. So there is a QR code on this slide. If you want to take a picture of that, you can actually be taken to our sustainable investment report, and it'll show all the different things that we're doing to help the different issues that are going on in the world, such as the human rights and making sure that there's affordable housing, the opioid epidemic. We're trying to do things that with our investments to help those types of situations to make them better. Now let's take a little bit more of a deeper dive into the actual investment categories and funds. Now, what I'm going to show you is for the for the boxes in the blue. Those are actually going to be the categories that we are having. Now, what's important about those categories is that if you know about those categories, then you'll know about how those investments are. So the Capital Preservation Fund, that's going to be on the conservative aspect. We're going to go from conservative to moderate to aggressive as we continue forward. But as far as the Capital Preservation Fund, let's think of that like a bank account or maybe a certificate deposit. The goal for this particular plan is safety. We want to make sure that things are running fairly stable, hence the name Stable Value Fund. So the first goal is safety, and then the second goal is income. So you do want to make sure that it is growing a little bit, but at least it's being stable. Not saying that you're going to make lots of money in this one or lose money, but it's going to be hopefully stable. We want to maintain like a $1 share price for this particular fund. Okay, so that's your Capital Preservation Fund. It has a lower risk and lower potential return. For the second category, it's the income funds or bonds. Now, again, the goal for this one is, again, stability, but this is more of a little bit more of a growth fund than your Capital Preservation Fund. So on here, it says bonds. So the income funds are bonds. What are bonds? So bonds are basically debt securities that, let's say, governments or municipalities or even companies tend to borrow this money, and then they have to pay back the interest. And that's what basically the bonds is, the debt security. The three funds that are listed here range from conservative, moderate to aggressive. The reason why the extended term fixed income fund is considered maybe more of an aggressive one, even though bonds are a little bit more stable, is that that term extended term, it goes for a longer period of time. So hence the potential volatility of the fund. Now the next category we have is balanced funds or stocks and bonds, or those is also called the income and growth fund. So what the goal here is for some more income in this one, because it does have a mix of stocks and bonds. All right, so this is a good category. It's like a one-stop shop for this particular fund. It's got bonds, it's got some stocks in there as well, but it's a good mix of those income and growth funds. Now, the last one we have is actually the equity or the stocks. Of course, the stock funds, those are going to be your most potential for return, but it's also your most potential for some risk. again, potential for the return. We've got two funds that are actually involved in that equity funds, and that's the U.S. Equity Fund and the International Equity Fund. So I'm going to let you make that assumption. Okay, what's the difference between the U.S. equity and the international equity? Well, I think you probably guessed that. So the U.S. equity is anything that's U.S. based, and then international is going to be anything outside of the U.S. Reason why that's the higher one is because you're going overseas, you have the potential for some additional risk there. So just want to let you know that these particular funds, they are large funds. The equity funds are very large funds. A lot of money is in there, and there's you know, a lot of different volatility that can actually happen in there, but it also has the most potential for growth. Now, I just want to give you a little information regarding another funds that we have, the Social Value Choice Suite of funds. These are actually types of funds that you can actually choose if you self-manage. And they are a couple of funds that are actually bonds, so they're, again, a little bit more stable, and then one that's actually a stock fund, so you have a little bit more potential for risk. This actually does have some of the assumptions that can be actually decided through your annual conferences. Now here's a great chart showing the risk and return, showing all of the funds that we have and where they lie on that risk and versus return scale. So when we talked about the capital preservation fund, that had the stable value fund, and that has the lower potential for risk as well as return. So that's at the lower end of the chart. So as you keep going up and up, you have your middle scale, your moderate and aggressive, moderate types of funds, and then up at the top you have your international equity, which is going to be your most return but also the most risk or potential for the most return. Okay, so I think that's a great chart just showing you how every fund just lies in that chart, and you have that as a good visual as far as what choices that you might want to self-manage, or if you wanted to have LifeStage Investment Management manage it for you, which again we'll be talking about in a little bit. Now, as far as this investment information, we have a lot of information at wespath.org. I highly encourage you to go out there and look. There's information out there regarding all the funds that we have, their daily value. So, of course, you know, as the stock market goes, every day there's a different value for each of those funds. So you can see that information that's out on our site. All the funds that I had listed on that chart with the risk versus return, you can see all the descriptions regarding those. Again, you can see the benchmarks, that how we rate against our competitors. And then you can also see what kind of fees are associated with these and see the comparative results. But again, if ever you want to know anything about any of these funds, it's all out at wespath.org. And we highly encourage you to go out there. Now, due to the recent market volatility, we want to let you know that we do have some additional resources out there on our website. Dave Zellner, who is our Chief Information Officer, he's actually put out a few videos regarding the recent market and how things are going and how you want to look at things through the long-term perspective. So again, now is, can be considered a good time to actually go out and buy some of those stocks or bonds out there. But as we know that the markets have come down a little bit, so the prices in that in your 401k or your 403b plans can actually look like maybe a little bit lower. But again, we're in this for the long term, and things do potentially turn around. But also want to mention about the market at a glance. We actually have those that come out monthly, and that actually does have additional information regarding our funds and what we're doing to help minimize some of those risks. But one of the other best features that we have is EY Financial Planning Services. They can actually help you through any questions you have as well. We understand that this may not be your only fund here at United, your United Methodist Personal Investment Plan. May not be your only fund. Maybe you have other ones. Maybe your spouse has other plans, other funds through something else. So you want to make sure that you're thinking about the whole picture and not just one piece of it. So EY can be a great benefit and resource for that. Now, as I alluded to, we talked about LifeStage Investment Management, and I want to talk a little bit more about that and what that actually is and what it means to you. So for LifeStage Investment Management, it's a tool. It's a great tool, and it's personalized for each individual person. Now, the one thing that I want you to think about when you think of LifeStage Investment Management is that it puts your accounts on autopilot. So you don't have to do or think about them anymore. So again, autopilot, LifeStage Investment Management, autopilot. Think of that. Now, I'm different than you. You're different from me. I'm different from Bob, and our retirement can be different. So that's where this tool actually is individualized for each individual person. So one of the great things about this is that it creates an investment portfolio that's meant for just you. Because again, you're unique, just like I'm unique, and everyone is unique on this call. So the funds that are picked for you are going to be for you and the types of where you're at in your life. What is your age? What is maybe your full retirement age? Are you going to be having Social Security? Are you eligible for that? So that's different things as to why this is individualized just for you. It does set up that asset allocation, and it's targeted just for you. But one of the, and actually this is for you during your active years as well as in retirement. So this doesn't just stop when you retire. It's still there for you when you retire. But one of the best things about this type of LifeStage Investment Management is that it rebalances your account so you don't need to. Again, keeping that account on autopilot. So one thing I want to show you is how that rebalancing happens. So there's going to be times when the plans drift or they move, they fluctuate. So let's, when you look at this piece of the pie, let's look at the purple one in the 29% to the 34%, the before and after. So what that is it's actually rebalancing that for you. So sometimes that amount goes up, or and sometimes it goes down. So what LifeStage does is it rebalances those percentages so that they're more consistent with the profile that you have set up. So that's what is wonderful about this, is that you don't have to worry about it. I actually am in this myself, and because I'm in the same plan as you are, and I love this. It's one thing, even though I know about these, it's one thing that I don't have to worry about. I've got other things to do in my day. I'm sure you do as well. So this is something that I don't have to worry about. And I will say that about 80% of the people who are in the United Methodist Personal Investment Plan are actually in LifeStage Retirement, LifeStage Investment Management. So you're in good company. So one thing I want to let you know is that if you did not complete an investment profile form like the one that's listed here on this slide, then what your default is going to be a moderate risk tolerance with a benefit commencement date of up to of age 65, and that you're eligible for Social Security. Now, if you didn't complete the form, that's fine. This is what your default is. But it's also something that's easy enough to change. Now, I am actually going to be, I'm hopefully going to be retiring when I'm 67. That's my full retirement age. But if I did the default, LifeStage doesn't have my correct retirement date of 67. So you can go out there and you can actually make that change. Also, I want to let you know that I actually just recently updated my risk tolerance. I was moderate and I upped it to aggressive. Maybe not the great time to do that, but I wanted to change it up. So I have a few more years to retirement. So I thought, hey, let's get a little bit more aggressive with my investment strategy. So that is something that you can actually do. Now I want to talk to you a little bit more about the participant experience. So we're going to talk through all of these different things on a pretty quick basis because we have gone through these before, but I just want to let you know about the benefit access. So you can find out all of your current account information out there on benefit access. There's the benefit projection tool. Now that's something that you can actually determine, maybe you're retiring in 10 years, 25 years, or maybe even next year. That will actually show you an approximation as far as how much your monthly amount would be. Again, your salary when you retire. So go out there, go out there and actually make sure you've registered for Benefits Access. It's a wonderful, wonderful tool with a lot of information. And remember that benefit projection is not a forecast. It's not stating this is exactly what I'm going to be getting in retirement. This is actually just an estimate, because again, counts can change. You know, your inflation for your salary can change. Maybe you're going to be retiring at a later date. Maybe you're going to go to 72. So that's always different factors that can change that benefit projection. But again, that can be done at any time. You can do that as many times as you like, if you like. This is just a quick sample of what the benefit projection looks like. And we'll go on from there. And also just letting you know that you have quarterly statements as well. Whether or not you're going to be in LifeStage Investment Management, that's actually going to be on page 3 of this quarterly statement. You can view your current account balances on that quarterly statement. You can actually view your account transaction details. Again, if you're in LifeStage Investment Management and you see transactions happening, that's probably because maybe there was a rebalancing that was done. And again, it'll only be done if it's needed to be. So, but if you see transactions out there and you're not self-managing, then that's probably a rebalancing piece that was done. So it's a good way to be able to see that. EY, can't tell you enough about EY Financial Planning Services. They are our financial strategic partner. Give them a call with any questions you may have. Again, personal, confidential help that they can give you. They've got a lot of tools, resources available on their website, many different topics that you can talk to them about, and they're available for you. Here's just a sampling of topics that you can talk to them about. You know, again, regarding your comprehensive retirement plan, as Bobby alluded to earlier, Roth contributions. Is that or is that not something that's viable or a good option for me? Again, managing debt, that's always a big one that people seem to have. Maybe if you want to set up a fund for your grandchild's education, that's definitely something you can talk to them about. But again, I want to make sure that you understand that no topic is too big or too small. In fact, a couple of our educators here, in fact, Bob was one of them, he called EY Financial Planning Services to see whether or not he should buy or lease a car. So again, it did affect his financial situation. So it was a call that he wound up making to them and got some great advice for them. Contacting Wespath, that's a great, we've got a great service here. The virtual one-on-one consultations, Bob did talk about that earlier as well. All of us are actually able to help with your questions that you may have. And in that laptop, that's actually Todd Creviston. He's one of the benefit educators. So again, we're here to help you. And if anything, remember that LifeStage Investment Management is putting your accounts on autopilot, and that Wespath is here to help you, whatever that case may be. And we happen to have great resources for you. We've got our participant solutions or our customer service team. They're there, totally there for you. Any question, again, no question is too big or too small for them, as well as for EY. You've got benefit access that you can contact, as well as, again, contacting us for those benefit education consultations. So it wouldn't be a webinar without having action planning your next steps. So if you can, or if you haven't already, elect or enroll in the UMPIP plan. If you want, you can go out and change your participation contribution at any time. If you want to change your risk tolerance, you can do that, as I did that. Determine your investment strategy, what counts are good for you, or if you want to sign up for LifeStage Investment Management, again, something you can do. Register, please register for benefitsaccess.org. It's there for you. A lot of great information. Again, on our website, wespath.org, you can actually see any additional webinars that we have or any other events. Again, we want to tout that CBA event that we're having in November. We're definitely looking forward to going out there and meeting and seeing everyone again in person if we can. And then also make sure that you sign up for our next or Q3 UMPIP webinar based on your your survey results. We're going to be, again, having lots of information out there for you because you're asking for it. So we are going to give you what you're looking for. Now, I want to thank you very much on behalf of Bob Christophel and myself, Sheryl Hatcher. Thank you so much for coming and sharing our Q2 webinar, UMPIP webinar today. And again, thank you so much. Take care and have a wonderful rest of your day.
Thank you all.